Hello students, welcome to BYJU'S IAS. Welcome to a session on economy this week, wherein we'll be taking up some of the very important articles that have appeared in various business related newspapers and we'll be analyzing these particular articles. For this particular video, I've taken the time period from 20th of April to 3rd of May 2020 and the articles that I've chosen are from Hindu, Indian Express, Business Standard, Live Mint and Business Line. So let's begin this particular discussion. The first article is related to repo auction getting very poor response. Before I discuss the points in the article, what are the basic points that you need to understand? In the recent times, RBI has taken certain very novel methods or has used certain novel tools in order to infuse liquidity into the market. Understand this very carefully. Earlier, when the pandemic started to set into India, there was an impact on the market. There is a disruption on the supply side, demand side. RBI, in order to address the distress in the economy, reduced repo rate. Okay, so it reduced repo rate. The objective was, if the repo rate is reduced, the borrowings by the banks will be at a lower rate of interest, and the banks will basically lend more in the market at lower rate of interest. To whom? To companies, let's say industries. And once the loans are given to the industries at a lower rate of interest, obviously manufacturing will be kick-started, or there will be revival of the economic activity, employment will be generated, growth will be revived. This is what is expected by RBI. But this did not happen, or in simple terms, there was inefficient monetary policy transmission. One reason that was cited by the banks was, yes, the repo rate has come down, which has meant that when the bank will take the loan from RBI for a shorter duration, the rate of interest that banks will pay to RBI will be very less. Having said so, banks argued that despite repo rate coming down, the amount of borrowing that we do from RBI under repo is very less. I'll repeat the statement. Yes, repo rate has come down. What I borrow for a short duration, I'll have to pay lesser rate of interest to RBI. But out of the total money that I borrow from the market, that is, the bank will borrow or raise money from the market from multiple sources, such as they will collect deposits from the households, they will collect deposits from companies or firms, they will also collect loans or take money from or borrow from RBI. So bank said, yes, the rate of interest that I pay to the RBI has come down. But this particular loan that I take from RBI is just a fraction of the total borrowings done by me. Is it okay? I will borrow from households at the same rate of interest. For example, let's say hypothetically, I'm bank, you will come to me and keep 100 rupees a fixed deposit. So earlier, let's say 3 months ago, I used to pay 6% rate of interest to you people. Even today, I'm paying, let's say hypothetically, 6% rate of interest to you people. So when I borrow from RBI for a short duration, the rate of interest that I pay as a bank to RBI is going to come down. But even today, when you give me 100 rupees, I'm paying you the same rate of interest. In simple terms, the banks said will not be able to transfer the full benefit to the borrowers in the market for a simple reason. The money that is coming from RBI to us under repo is just a fraction of the total money that we are collecting. And since it is just a fraction of the total money that we have taken or borrowed from the market, we cannot reduce our overall lending rate in the market. Now what has RBI done? In order to address this particular issue, RBI introduced two very important new types of tools. One is LTRO and the second one is TLTRO. Okay. LTRO stands for long-term repo operations. TLTRO stands for targeted long-term repo operations. Now please remember this, whenever you use the term repo, generally under repo, usually the lending and borrowing between RBI and the banks will happen for a shorter duration. For example, 28 days. But under LTRO, look at the name there, long term. In essence, under LTRO, RBI gave loans to these particular banks for a duration of up to 3 years. Please differentiate between the normal repo and long-term repo. In case of a normal repo, the lending will take place for a shorter duration. Whereas in case of a long-term repo, RBI lends to the banks for a duration of up to 3 years. That is 1 year, 3 year. That is the first very important point. Second, if a bank takes a loan from RBI, what is the objective there? Objective is RBI is trying to ensure that the bank borrowing from RBI for longer duration will increase. In essence, capital which is available for the banks for a longer duration increases. Hence, they can lend it in the market for a longer duration and also reduce the rate of interest. That is one of the very important points related to LTRO. Third very important point. When a bank will take loan from RBI under LTRO, it has to provide certain collateral, that is security. Now, when the bank will take this particular loan from RBI, it will submit G securities of same tenure or higher tenure with RBI. What is the meaning of this? Let's assume I am a bank, you are RBI. You have given me a loan for a duration of 3 years under LTRO. Now, once I have taken a loan for a duration of 3 years, I will have to give you a security or a collateral. I will submit G securities whose tenure or the maturity period is a duration of 3 years or more than 3 years. So, the G securities which are submitted as a collateral should match the tenure of the loan or should be higher than the tenure of the loan. So, that is another very important point. Fourth very important point. With this particular introduction of LTRO, now the banks will have to submit the G securities to RBI. As a result of this, the demand for G securities in the market is going to increase. Because imagine, again, you are RBI, I am a bank. I will have to give you G securities. But to give you securities or pledge the securities to you, I will have to have securities. That is G securities. I will purchase more G securities from the market. And when I purchase more G securities, one, Government of India will be able to sell the G securities to me and collect the money. And second very important point, the yield rates of G securities will change. The yield rates of G securities will change. In what way? If the demand for the G securities increases, which will happen because of LTRO, the market prices of G securities will increase. Just understand the sequence here. If the demand for G securities increases, market prices will increase. And when the market prices will increase, yield rates on the G securities will decrease. Now again, this particular relationship between yield rates and G security market prices is a very elaborated discussion. All you need to understand as of now simply is this. In case of the bonds or G securities, simply remember this, the market prices are inversely proportional to yield rates. Is it okay? The market prices are inversely proportional to yield rates. In simple terms, when market prices will increase, yield rates will come down. And when market prices will decrease, yield rates on the bonds will increase. Is it okay? So, this is what is expected. The demand for G securities will increase, market prices will increase, yield rates will come down. And what is the importance of reduction in the yield rates? The yield rates on the G securities usually influence the lending rates in the market. The most important G security which has an influence on the lending rates or the interest rates in the market is the G security with the tenure of 10 years. But anyways, this is what is expected by introducing the concept of LTRO by RBI. Now apart from this, I also used another very important term here, TLTRO, Targeted Long-Term Repo Operations. Another very important novel tool. UPSC might pick up this in the form of a question either in the prelims or mains. Please be very careful. Now understand this. In case of a LTRO which has been introduced by RBI, and one more very important point here, RBI is not the first bank in the world to introduce this concept of LTRO. In fact, for the first time, this particular model of LTRO was implemented by ECB, European Central Bank, long back in the last decade after global financial crisis. Now, in case of LTRO, I said banks will take loan from RBI for a duration up to 3 years, then give loans in the market. That is what is expected. But in the recent times, there have been certain issues with respect to corporate borrowings or corporate debt market. Or in simple terms, after the onset of the pandemic, there was uncertainty created in the economic system. And whenever such uncertainty or volatility is created in the financial market, that is equity market as well as debt market, you will see there is a large sell off. So, whenever there is uncertainty or the volatility is very high in the market, you will see that investors will start selling these kinds of instruments in the market. Now, imagine if you are a company, you have wanted to issue bonds in the market and raise a certain capital. But because of this particular volatility in the market, people are not willing to invest in your bonds. People are not ready to purchase your bonds. As a company, you will find it very difficult to raise capital, raise money, raise resources. So, one of the ways that RBI is trying to address this particular issue is by introducing a new tool called as targeted long-term repo operations. Now, what will happen in TLTRO? Let me explain it. Same concept again. You are RBI, I am a bank. I will be allowed to take a loan from you under this particular tool of TLTRO, and you will charge me only the repo rate. Is it okay? I'll take the loan from you. You will charge me a repo rate. But you will impose one condition. RBI will impose one condition on the loan that is given to the bank under TLTRO. What is the condition? I will have to use this particular money to purchase debt instruments in the market. I'll repeat the statement, very, very important. Under TLTRO, RBI will give loans to bank at repo rate, but with the condition that in the next 30 days, bank has to use this particular money to purchase debt instruments in the market. Now, what kind of debt instruments? Please understand this very carefully. In the market, these kind of debt instruments are given a credit rating. What do you mean by credit rating? In simple terms, credit rating will represent credit worthiness of the borrower in the market. For example, you go to bank to take a loan. Before bank can give you a loan, they will assess whether you are credit worthy borrower or not. For example, they will ask you for CIBIL score, Credit Information Bureau's score, which will basically represent, or which is a numerical representation, which will tell whether you are a credit worthy borrower or not. Credit worthy borrower in simple terms means whether the loan that you have taken, you will repay it or not. If you have repaid all the loans that you have taken, you have not defaulted on any of your loans. If your credit cards are paid on time, then your credit rating will always be very, very high. And since your credit rating is very high, it becomes very easy for you to take loans from the bank, because the bank will evaluate you as a very good borrower. So understand this very carefully. Just like an individual borrower, even corporates will also be given credit rating. The bonds or the debt instruments that they issue in the market are given certain credit rating. Based on the credit rating, we will decide whether this particular bond is safe or risky. For example, you must have seen a credit rating such as a AAA, BB, B, right? And the worst credit rating is D. There are 3 credit rating agencies, internationally acclaimed or internationally recognized agencies. One is Fitch, second one is Moody's, and the third one is Standard & Poor, that is S&P. If you see these credit ratings which are given by these particular agencies, they'll basically give multiple, or they will have a multiple credit ratings. These ratings will be divided under 2 heads. One, some of the credit ratings such as AA, AAA, BBB, single A. These particular credit ratings are referred to as investment grade credit ratings. And any rating which falls below certain criteria, that is BBB rating, these ratings are called as junk ratings. Okay, so until certain rating is provided, until certain rating is reached, these investments or instruments will be referred to as investment grade ratings. Below that, they will be referred as junk ratings. What is the idea there? Let's say till triple B, that is a usual parameter. Till triple B will refer to these particular grades as investment grades. Means if you invest in any bond which is rated at triple B, double A or triple A, safety is high. Highest safety will be given in a bond which is rated at triple A. And if you invest in a bond which has been given a rating of let's say C or D in the worst case scenario, these particular bonds will carry very high amount of risk. Is it okay? So the bonds based on the credit rating can be either investment grade bonds or junk grade bonds. Now come back to the discussion here. Under TLTRO, I said if you're RBI, I'm a bank, you will give me a loan under TLTRO. In the next 30 days, I'll have to take this particular loan, invest in the bond market or let's say debt market generally. In what kind of instruments? RBI says you're allowed to take this particular money and invest in only investment grade debt instruments. Is it okay? You will have to invest only in investment grade debt instruments. In essence, RBI is giving loan, ensuring that this particular money will flow into these particular corporates which are issuing bonds, but the security element should also be addressed. By doing this, RBI is ensuring that corporates will also get access to loans or borrowings by selling their bonds in the market. Another very important point related to TLTRO. 1. Follow this very carefully. These particular instruments which are purchased by a bank will have to be entered as held till maturity in the balance sheet of the bank. I'll repeat the statement. It's a very technical concept. I'll explain it. These particular instruments or debt instruments in which the banks will invest will have to be entered as held till maturity or held to maturity in the balance sheet of the bank rather than marking to market. I'll explain both the terms. I'll repeat the statement again. The bank will have to enter the value of the bonds as held till maturity rather than mark to market. What is the idea here? Imagine you are a company which has given me a bond, which has sold the bond to me. That is, I have purchased this particular bond. The prices of the bond will keep on varying. Is it okay? Market prices of the bonds will keep on varying. And when the market prices of bonds will keep on varying, the value of bond that I am holding will also keep on varying. Whenever I keep this particular bond as a mark to market, that is, when the market prices will keep on changing, the value of this particular bond in my balance sheet also will keep on changing. Is it okay? Mark to market, M-A-R-K, mark to market means the market prices of these particular instruments will keep on changing. Asset prices will keep on changing. When prices will change in the market, the value in my balance sheet also will keep on changing. On the other hand, held till maturity or held to maturity basically means if I've given 100 rupees to you and I've purchased the bond from you, I will enter the value of 100 rupee till the bond becomes matured. Whatever be the price change in the bond, I will not enter that in the balance sheet. So what is the advantage of this? The bond prices are very volatile right now. And if the bank is forced to enter these particular values of the bonds under mark to market, whenever the bond prices will change, the size or the value of these assets in the balance sheet will also keep on changing. That will put a pressure on the bank. Rather than that, RBI has told the banks to simply keep them under held to maturity. Is it okay? Under held to maturity. So that once they purchase, they will keep it in the same price. The value will not keep on changing, whatever be the value in the market. Next very important point regarding TLTRO. Understand this? I said the bank will take the loan from RBI, has to use it within next 30 days to purchase the bonds. What if they don't do it? That is, your RBI, I have taken loan from you under TLTRO. In the next 30 days, I am supposed to purchase debt instruments in the market. I have not done it. So what is the next point? Under this particular scenario, RBI will charge repo rate plus 200 basis points on such loans. Is it okay? If I take a loan under TLTRO, RBI will charge how much? Repo rate. Whatever be the repo rate, they will charge the repo rate. Provided I use this particular money to purchase debt instruments in the market. What if I don't do it? After 30 days, if I don't do it, then RBI will charge additional 200 basis points, in simple terms 2 percentage points over the repo rate. For example, if the repo rate is 4%, if I don't use this particular money in the next 30 days, then I will have to pay a rate of interest of 4% plus 2%, that is 6%. And the last point related to TLTRO is this. The banks might use this particular money to purchase a debt instruments either in the primary market or secondary market. I'll repeat it. Banks may use this particular money to either purchase the bonds or debt instruments, to be more precise, either in the primary market or secondary market. What is the idea here? In case of primary market, the company directly sells these particular bonds. The issuer is the company. Whereas in the secondary market, the issued bonds are traded in the market. Is it okay? So these are the very important points related to LTRO and TLTRO. Now, having understood the concepts now, what has been given in the article? Very simple information. Though RBI has stated that they will be issuing more than 1 lakh crore rupees under these particular tools, banks have not been very enthusiastic about these particular tools. For a simple reason, they are saying that market is very volatile. It is very risky to lend in the market. Or else they will use the term banks have become risk averse. Since the banks have become risk averse, RBI wants to push the liquidity in the market. But banks are saying we might opt for borrowing, but we will not be lending all of it in the market. So that is the gist of the article given here. So based on this, now let's take up a question. Consider the following statements about TLTRO. Under this, banks can borrow at repo rates. Yes, it is correct. This money borrowed by banks will have to be used to give loans to only MSME sector. No, this is wrong. Only first statement is correct. Option A, that is only one, is true. I've also given a descriptive question. I've discussed all the facets related to LTRO and TLTRO. You will have to write in 250 words this particular explanation about the LTRO as well as TLTRO. So this is the question related to the article there. Second article, reverse repo rate. In the last couple of months, there has been a lot of discussion related to the concept of a reverse repo. For a simple reason, understand this very carefully. RBI reduced the repo rate. RBI has increased the access to capital or liquidity in the market. Presuming that banks will take loans from RBI, lend to industries or corporates. Again, same concept, which will lead to what? Growth, employment, so on and so forth. But actually what has happened? Banks have increased their money that they have deposited or money that they have parked with RBI. As per one estimate, in the month of February this year, the amount of money that was parked by the banks in RBI was somewhere just over 39,000 crore rupees. But within the next couple of months itself, because of this particular uncertainty and volatility that has been created in the market, banks have become risk averse, taken their deposits or excess money that they have, gone to RBI, simply parked these particular funds with RBI. At one point of a time, the amount that was parked by the banks with RBI was over 7 trillion rupees. The amount of funds that were parked by the banks with RBI was over 7 trillion rupees, which essentially means what? Banks, rather than lending the money in the market, are parking the funds with RBI, and on this particular money are earning reverse repo rates. Is it okay? This is a concern for RBI. And this article basically says RBI may simply think of imposing certain restrictions or certain limits on how much money that could be parked by the banks with RBI. So that if RBI imposes a restriction, banks will not have any other option but to lend this particular money in the market. Money flow or liquidity in the market will increase. We are expecting a virtuous cycle of a growth after that. So this is the gist of the article given here. Based on this, I've given a question. Consider the following statements about reverse repo rate. It is used by RBI as a part of LAF. Now, what is LAF? LAF basically stands for Liquidity Adjustment Facility. Under this particular concept of LAF, RBI uses tools such as repo rate, reverse repo rate, etc. to adjust the flow of the liquidity in the market. They will try to adjust, or RBI tries to adjust the flow of liquidity, right? Especially in the banking sector. Focus on the banking sector using this particular tools under the liquidity adjustment facility. So is a reverse repo a tool of LAF for RBI? Definitely yes. It could be used as a tool by RBI to control inflation. Is it okay? When RBI controls money flow in the system, they will also be able to control the inflation rate also. I have to understand this. Money flow can be controlled in multiple ways. RBI can use CRR, RBI can use SLR, repo rate, reverse repo rate, open market operation. Multiple tools can be used by RBI, right? Either to increase the money flow or decrease the money flow. And when there is increase in the money flow because of these particular tools used by RBI, there's a danger that it might promote or lead to higher inflation rate. And when reverse repo could be used to control the money flow in the system, can it control the inflation? Definitely yes. So it is also a tool that could be used by RBI to control inflation. Now again, simply remember this. Any tool which helps RBI to either increase the money flow or decrease the money flow obviously will have an impact on the inflation. Now you will ask me a question. How is reverse repo associated with the money flow in the system? Usually you see this particular trend. Again, usually, do not apply it in the current context. Why? This is an abnormal situation. Usually what you see is simply this. If RBI wants to promote more and more lending by the banks to, let's say, borrowers in the market, RBI simply abruptly reduces the reverse repo rate. Even now also it has been done. But the only problem is the risk or uncertainty and volatility in the market is so high. What do you mean by uncertainty here? Nobody knows till what time period this particular COVID-19 will keep on influencing or having an impact on economic activity in India. So until unless we know the end point, until unless we know from what time period there is going to be a revival of economic activity, on what basis do you want the banks to decide their lending? So that is the reason, until unless this type of uncertainty will keep on existing, you cannot expect any kind of a decision making from the banking sector. So what can be done, or what is usually done by RBI is simply this. Whenever they want to increase the bank's lending to the market, generally in normal situation, they will suddenly drop down their reverse repo rate. And when RBI reduces its reverse repo rate, banks, if they give or park their money with RBI, they will earn very small amount of interest. Now the banks do not have any other option but to lend it in the market so that they will earn higher than that. So can this be used to control money flow in the system? Control liquidity in the system? Definitely yes. So when liquidity is controlled, that is regulated, obviously there is an impact on inflation. So first is correct, second is correct. Right option is option C, both are true. Next article is related to white label ATMs. What has been given in the article? We'll go to that later. First of all, what is a white label ATM? Understand this. A couple of decades ago, we had these particular concepts of ATMs, that is in-house ATMs. These particular ATMs were owned or operated by banks themselves. Is it okay? They were operated by banks themselves. After a couple of years, after certain penetration of the banking services or ATM services, the demand for ATMs started increasing. Banks decided to open up ATMs in multiple areas. But please understand, the core operation of the bank is banking activity, not running ATMs. So they introduced a new concept called as brown label ATM. Under brown label ATM, what will happen? The bank will take care of operations such as cash refilling, internet connectivity, and other operations will be taken care of by a third party. That is, a financial institution will take care of other activities such as taking ATM machine on lease, taking certain place on lease where the ATM will be installed, taking care of electricity connections, so on and so forth. These particular ATMs were referred as brown label ATMs. You can see even in case of brown label ATMs, just like in-house ATMs, the sponsor banks or the respective banks have played an important role. Now another generation of ATMs have been introduced in case of India in the last decade, especially in the second half of the last decade. These ATMs are referred as white label ATMs. In case of white label ATMs, what happens? The ATMs are set up and managed by another company altogether. Is it okay? The ATMs are set up as well as managed by another company. For example, Tata. They have their own white label ATMs. For example, you must have seen the brand or logo of Tata IndiCash. That is a white label ATM of Tata itself. So they have their own ATMs. In simple terms, they are running their own operations. They will take care of all the facets related to functioning of an ATM, refilling, connectivity, so on and so forth. Now, when these particular companies are operating, let's say financial institutions are operating the white label ATMs, how the transactions will take place. There comes the concept of interchange fees. Now, what is this concept of an interchange fees? Imagine a situation, you have got a card of another bank. Let's say for understanding SBI card. You want to use this particular ATM card in a white label ATM which is owned by Tata company. Now, if you use this particular card of SBI to have a transaction in white label ATM, that is Tata IndiCash, this particular Tata IndiCash will impose certain charges on SBI bank. Why? This white label ATM has provided or facilitated a transaction of a different bank. This particular charge which is imposed is called as interchange fees. This particular interchange fees has been the focus of discussion for a simple reason. The interchange fees which are charged by white label ATMs are very, very less compared to the other banks. This has been one of the reasons why there has been a viability issue of these particular white label ATMs. And after the imposition of the lockdown, this particular viability problem has become much more acute. That has been discussed in this particular article. On general basis, on normal basis, even without the pandemic, the volume of transactions which would have happened in white label ATMs are comparatively very less. And the white label ATMs incur huge amount of a fixed expenditure. It is said that out of the total expenditure incurred by these particular white label ATMs, 75% of the expenditure is fixed. And when they are incurring such a huge amount of expenditure, interchange fees is very less. And because of the lockdown, the number of transactions, volume of transactions have come down. It has become very difficult for these particular companies to maintain or operate these particular white label ATMs. All these particular factors have come together and are basically hitting at the viability of these particular white label ATMs. That is the point of discussion in this particular article. Now, why do you think these particular ATMs are very, very important? RBI, in order to promote accessibility of the financial services, in order to promote financial inclusion, in order to ensure that the points of financial transaction, such as ATMs, penetration increases, introduce this particular idea of a white label ATMs. And now we are seeing that there is a problem of viability issue of these particular white label ATMs. So this is a discussion related to the points given in this article. Now based on this, I have given you a question. Consider the following statements about white label ATMs. Institutions are authorized to provide these services under Payment and Settlement Systems Act of 2007. Yes, this is correct. Under this particular act itself, these institutions are allowed to open white label ATMs. WLAs will provide only cash withdrawal facility. This is wrong. WLAs will provide multiple types of transactions. Multiple types of facilities are provided. Cash withdrawal facility is one of them. For example, these particular white label ATMs will also provide you certain value added services such as mobile recharge, utility bill payments, so on and so forth. So only cash withdrawal, this is wrong. So first statement is true. Right option will be option A, only one is true. Next article is related to the bypassing of the MPC framework by RBI in the recent times. What is the information given in the article? It has started from 2008. So in the year 2008, there was a global financial crisis, to be more precise, 2007 as well as 2008. So there was a global financial crisis, and as a result of this particular global financial crisis, Indian economy was also affected by this. After this particular crisis hit Indian economy, RBI through various measures increased the money supply in the market. As a result of this particular huge amount of liquidity that was present in the system, We also faced certain issues such as inflation rate, taper tantrum, so on and so forth. Now, after this particular issue happened, Government of India went for a monetary policy framework. That is, the Government of India set up MPC, Monetary Policy Committee, wherein the composition of 6 or out of 6 members, 3 were from RBI, 3 were the experts appointed by Government of India. And not only this, we tried to make this particular process much more transparent. That is, monetary policy making process was made much more transparent, as this particular committee used to decide on what should be these particular rates to address various targets in the market. For example, under MPFA, Monetary Policy Framework Agreement, Government of India asked RBI to maintain the inflation rate at 4% with a bearance levels of 200 basis points. In simple terms, inflation rate shall keep on hovering between 6% to 2%, assuming 4% is a standard or the level. RBI should not allow the inflation to cross 6% nor allow it to fall below 2% also. So this particular target was set up by Government of India, and Monetary Policy Committee now used to take a decision related to these particular targets. But in recent times, after the pandemic has set in, very now and then, very often, you must have seen RBI is taking these particular decisions alone. It is deciding related to reverse repo. It is decided to increase liquidity by using tools such as LTRO, TLTRO. It has also used various tools such as Operation Twist to address the yield rates or increase liquidity in the market. So the argument in this particular article, which has been written by one of the former RBI governors, very well respected RBI governors, Mr. Urjit Patel, is that since RBI is deciding these particular tools to be used and trying to address the liquidity in the system, then what is the role of the Monetary Policy Committee? When RBI itself is using these tools and addressing the liquidity or varying the liquidity in the market, don't you think it is circumventing or it is simply cutting short the concept of a Monetary Policy Committee? That has been discussed in this particular article. Now you will simply ask, what will happen if you are doing like this? What is the problem? Let them do it. Right now the situation warrants it, so they are doing it, let them do it. But the larger picture is, if RBI is taking these measures and deciding the liquidity in the market, then the credibility of the Monetary Policy Committee will be affected. MPC was set up in order to increase the credibility of the decision making and transparency of the decision making. But if RBI takes all these measures and ensures the liquidity measures or liquidity problems are addressed, then the credibility of MPC will get affected. That has been the argument in this particular article. So this is a discussion related to points given in the article. Based on this question, consider the following statements. MPC shall meet at least 4 times in a year. Yes, this is true. MPC shall meet at least 4 times in a year. RBI governor has the veto power in the MPC. No, RBI governor does not have a veto power. RBI governor has a casting vote. What is this idea? Follow this very carefully. Right now we are following a bi-monthly monetary policy. What do we mean by bi-monthly? The monetary policy shall be announced once every 2 months. Is it okay? The monetary policy shall be framed or revised once every 2 months. This is bi-monthly monetary policy. And within the Monetary Policy Committee, I said there are 6 members. 3 are the representatives from RBI, including RBI governor obviously, and 3 are the experts who are appointed by Government of India. Now, imagine this situation. Out of 6 people, 3 are in the favor of reducing repo and 3 do not want any kind of a reduction. So there is a tie here. In case of a tie, which should be the decision? Which side should the decision be favored? In such cases, when there is a tie, RBI governor will be given 1 vote, 1 additional vote to break the tie. Have you understand this? RBI governor will be given 1 additional vote to break the tie. This is referred as casting vote. Earlier system, in the earlier Monetary Policy Committee, there were 5 members, including RBI governor, without any representation of the experts. There were no outsiders allowed. RBI itself appointed 5 people. Now understand this. In the earlier system, out of 5 people, obviously RBI governor was one of them. In the earlier system, RBI governor had a veto power. Is it okay? RBI governor had veto power, which means irrespective of what other four people say, the decision of RBI governor will be the decision of the Monetary Policy Committee. This has been taken off. We are giving him a casting vote, not a veto vote. Okay, so first statement is true, second statement is wrong. Right option will be option A, only one is true. So these are the various articles as well as the questions related to these particular articles for this particular time period. Thank you. Have a good day.